Good morning. Thank you for joining us today for our 2021 budget review. I'd like to begin today by acknowledging the traditional owners of the land on which I'm coming to you from, the Wangal clan of the Eora Nation, and pay my respects to elders past and present. Before we begin the budget review, I'd just like to introduce you to Inline Partners and the team here. So my name's Lauren Evans, and I head up the bookkeeping and reporting services function. So I focus a lot on the bookkeeping and CFO reporting services, management reporting, KPIs, forecasting and budgeting, things like that for clients. We have David Marchart, another director, who's focused on general business advisory and compliance, and Christy Lim, our technical director. She specialises in tax advice, tax planning, structuring and retirement planning. Just a bit of housekeeping, a disclaimer that this is just general information and not advice. So if you do need specific advice relating to your circumstances, please contact the office and we'll go through that with you. Just what we're going to cover today. I guess the purpose for running this session was, I don't know about you, but I have had a lot of information come through regarding the budget, and it's all, thousands of pages of information. I don't like to read very much. So I guess the purpose here was to provide you with a short, sharp information session that you don't have to read the thousands of words of information to get an understanding of what has been announced and how those things will affect you. So what we're going to cover off is just the key budget focus, which is about in terms of dollar values, where the dollars are being spent, the specific initiatives for you and your family, specific initiatives for business. I won't run through that list right now, but we'll have a slide on each of those things where I can explain that further. And then just some other things that won't be common for everyone, but just a few things that I can touch on that may affect some people. So as I mentioned, just the key focus for the budget in terms of dollar values where the money is being spent significantly is the digital economy, education and training, particularly for women and children and business owners, in line with also that digital economy side of things. Health and aged care, low and middle income offset, and the small business tax incentive. So from a dollar value, that's where a lot of the funds are being spent. So let's just touch on you and your family and the things that will impact you directly. So the first thing is the extension of the low and middle income tax offset. So this was due to end 30 June 2021, but has been extended another year to 30 June 22. So this will provide individuals with up to a maximum of $1,080, or for dual income families, $2,160. So if you earn below $37,000, the offset will be $255. Between up to $90,000, you should receive the maximum, and then it starts phasing out after that. And it will be no longer available when the taxable income is $126,000. So the next one is increasing the Medicare levy low income threshold. So that will just save around $1,000 for singles in tax each year. So that's good. The next one is the First Home Super Saver scheme. So this scheme was due to end, but has been extended until 1st of July 2022. And And so what it allows people to do, if you're buying your first home, you can withdraw any voluntary contributions that have been made to your super fund. You can withdraw up to $50,000. It was previously $30,000 and it's been increased to $50,000. There is the first home loan deposit scheme. So what this is it allows, the government will guarantee some of the deposit. So that means that if you're buying your first home, you can have a lower deposit without needing to pay any mortgage insurance. In terms of super changes, contributions to super, there's two main things there. The first one is for older Australians. There's a work test. So if you wanted to voluntarily contribute to your super fund, between the ages of 67 and 74, you would have had to meet what's called a work test, meaning you have to work a certain number of hours per week for you to be able to voluntarily contribute. So the age limit on that used to be 74, it's been decreased to 67. Now, the other change there for super is the downsize of super contributions. So the purpose of this was people over the age of 65, now 60, can sell their larger family homes and contribute up to $300,000 of the proceeds of that into their super fund. I guess the purpose of this particular thing was so that designed so that there's more larger family homes available to the market as older Australians sell out of their big homes and move down into smaller size homes. The Home Builder Grant. So this is a grant that has been available for a little while, and it's a grant that you can get between $15,000 and $25,000 for extensions to your house or renovations to your house, substantial renovations, or building a brand new home. There's some criteria associated with that in terms of thresholds and things like that. But there's two changes. One is it was extended until March 2021 for building contracts entered into before that date. It was previously December 20. And in addition to that, the construction commencement was originally needing to start within 6 months of the contract sign date. That has now been extended to 18 months. The next one is the Family Home Guarantee Scheme. So this is specifically for eligible single parents. And what this means is that the government will guarantee 18% of the deposit. So there's 10,000 of these guarantees available. So that means that eligible single parents will only need a 2% deposit for a loan to buy a home. Now, it doesn't have to be a first home for this particular scheme. And yeah, I guess the only downside of this is obviously your borrowing is a lot more, which needs to be paid off, but at least it's a step to get some of these eligible single parents back into their own homes. The next one is to do with childcare subsidies. They've increased the rebate for more than one child. It's quite significant. It can go up to 90%. And secondly, they're going to remove the annual cap. So previously there was a cap just over $10,000. You couldn't get any more childcare subsidies after you reached that cap. That's going to be removed, but that's only from July 2022. So that's another year away. And the last thing there is just self-education expenses. So previously there has been a threshold where if you spend money on self-education, you are not allowed to deduct the first $250. That will be removed, and that's just for simplification purposes and makes a lot of sense. Okay, let's move into the, I guess, the things that are going to affect businesses. We've got the small business tax rate. Now, this isn't something new, but it's just been confirmed that the small business company tax rate will reduce to 25% from 1st of July 2021. So that was planned already. So that is available, I guess, to what's called base rate entities. So you need to have a turnover less than $50 million. And then the key one is the passive income. So you need to have at least 20% of your income is not passive to be able to get that base rate entity. So if it's a purely investment entity and your only income is dividends and interest, for example, then you will not be able to access this lower tax rate. You will still be taxed at 30%. Okay, so the next one is called full expensing. So you may have heard the term instant asset write-off. Instant asset write-off is something that's been around for a couple of years. It started at $1,000, then $30,000, and then around COVID incentive time, it was increased up to $150,000. Now that instant asset write-off ended on the 31st of December 2020. In its place, the government has brought in full expensing. So what that means is there's actually no limit on the dollar value of the asset write-off that you can claim. And this is available until June 2023. It was due to end 2022, but that's been extended an extra year. Now the asset must be installed and ready for use between October 20 and June 23. And it's just, I guess the key thing to note here is it's not a cash refund. It's just a tax deduction, and it's actually just a timing difference. So if you have purchased an asset that is $200,000, for example, and the effective life of that asset is 5 years, you would have received tax deductions for that over 5 years. What this is actually doing is bringing forward that tax deduction to the first year. The other thing that I'll just note about this, which is down here in the pink box, which is quite, it sounds all well and good to get this big tax deduction 1 year, but just be mindful that if you're going to sell that asset within the next few years, then the impact of claiming a tax deduction up front means that you have that asset has no value for tax purposes anymore, which means that when I sell that asset, I'm going to be taxed on the full value of the sale proceeds of that asset. So if this is for an asset, if you're purchasing an asset that you only intend to hold for a couple of years and you will sell it, your intention is to sell it within a couple of years and you will get a dollar value for it, just be mindful that you will be subject to tax for the full value of those sale proceeds at that time. Now, I'm going to touch on the next page about what's called loss carryback provisions. The purpose of this full expensing is to actually be used in conjunction with loss carryback provisions. So I'll talk about that in a second. So loss carryback provisions is where if you have made a tax loss in the years 20, 21 or FY22, this budget has also extended that to include FY23 as well. So if you've made a tax loss in any one of those years, you can actually offset that tax loss against a taxable income in any of the years prior, starting from FY19 onwards. Now, it's an offset, so it doesn't necessarily mean you will get cash. However, if all of your previous year's tax has been paid and it's fully up to date, you will likely receive some sort of refund, because you're essentially saying, so say for example, last year you had a taxable income of $100,000, you paid tax on that. Let's, for simplicity's sake, say it's the 30% tax rate at $30,000. And this year I've made a tax loss of $100,000. I can then go back and say, okay, that $100,000 is going to be offset against my $100,000 loss profit from last year. I want my $30,000 tax back. And so you'll receive an offset for that. Now, I guess the key thing to note here, it's limited to your current year's franking account balance. So you can't get more back than you have paid in tax. And if you don't carry it back and offset it against a prior year, you can still carry your losses forward like normal. So like I said, the purpose, this is used supposed to be used in conjunction with, or can be used in conjunction with, the full expensing. So say I buy like a $200,000 piece of equipment for my business and make a loss in this financial year because I've deducted that in full, then you can use these loss carryback provisions to potentially get some cash back or a refund back from prior year tax paid to help with the cost of buying that asset. Okay, the next one is the SME recovery loan scheme. So this is something that was actually brought into effect as part of the COVID stimulus packages. And so what it allows small businesses to do is to actually access better borrowing. So the government would actually guarantee 80% of the borrowing. You've got a maximum loan size of 5 million, maximum term of 10 years, and it's got a low capped interest rate. It also offered repayment holidays, so you didn't have to make any repayments for up to 24 months. Now, this is still in effect, but it's also been extended now to include any businesses that were affected by floods in March 2021. It was previously only available if a business had received JobKeeper payments for essentially the first quarter of the JobKeeper this year. The next thing is around small to medium enterprise digital support. So there's I've got a link here on this slide, which is about, takes you to the business.gov.au website. There's a digital solutions page, and it's basically an advisory service, which is highly subsidised by the government. So the advisory service includes one-on-one support, workshops or webinars at a free or highly discounted rate, covering things like, what software you can get access to in your business, how to set up websites or sell online, how to do social media and digital marketing, and just in general, how to take your business online. And I guess one of the driving factors of this is, last year, a lot of businesses were immediately forced to go and work from home or figure out a way to do things online. And so, yeah, this is kind of, I guess, a reaction to that. This service is available for businesses with less than 20 staff or FTE equivalent. And like I said, it's at a highly subsidised rate. And yeah, there's lots and lots of things on there. So I'd highly recommend going and having a look at that. The next one is the $450 super guarantee charge threshold. So previously, if you earned, for any employees who are earning less than $450 per month, there was no requirement for employers to pay any super on that income. However, effective July 2022, so it's 12 months away or over 12 months away, that threshold will be removed. So that means as an employer, you will be required to contribute super from the first dollar an employee earns. So the purpose of this is just to, I guess, get people super topped up a bit more. And in particular, the budget documentation does say that this is expected to be for like 300,000 individuals will actually get additional super contributions as a result of this. And 63% of those will be women. So women who are working, part-time and things like that. So I guess from an employer perspective, this will be an additional cost. So that's just something to be mindful of. The other thing in the pink box down here that I'd just like to highlight is just a reminder that from 1st of July 2021, so this July, the super guarantee rate will increase to 10%. I'm pretty sure most software systems, if you're using them, which you should be for single touch payroll purposes, will actually increase that rate for you automatically, fingers crossed. Watch this space. But one thing I wanted to just point out here is that if you're staff are on a salary package which is inclusive of super, that means their gross take-home pay or their gross salary component will actually reduce because you're taking that extra 5% out of their salary. 0.5%, sorry. So if you're using a payroll system and you've got pay templates set up in that system, you will actually need to change the gross salary amount for this to work out correctly. If you need any hand with that, just give the office a call. I'm happy to help out. So the next one is self-assessing the life of intangibles. So this is on the digital space, and this only comes into effect after the temporary full expensing ends, which is June 2023. So the purpose of this is to continue incentives to invest in digital and software style things, so patents, registered design, copyright, etc. And so what this allows you to do is, instead of using the statutory rate and deducting these assets over a long period of time, you can say, okay, that's only for 2 years worth, and get tax deductions, like bring them forward essentially. All right, we're on to the other page, which is a very wordy page. So this is just touching on some of the, I guess, other things that were covered in the budget, just to highlight them in case, there are something that is relevant to you. The first one is employee share schemes, just removing the taxing point. So if you were to leave, if you were to be involved in an employee share scheme and then leave, you were taxed on the value of those shares at the point of leaving. So that is going to be removed. And so employee share schemes is quite a complicated thing, and so it was putting off employers from actually implementing them. So hopefully this will allow employees to, give them more free rein to enter into some of these schemes. The next one is what's called a patent box. So this is for medical and biotech companies, and there's been quite a bit of talk around why is it just these two industries. So watch this space, that may expand. But medical and biotech, if they meet certain criteria, will only have to be taxed on 17% of their income. Now, this will be relevant to how much R&D they're actually undertaking within Australia. So yeah, that's just something, obviously, if that's relevant, there's a lot more detail on that. And so that would need to be researched, I guess, if that is for you. So the next one is tax relief for brewers and distillers. So there was a cap here. It's now been increased to 350 instead of 100,000. So that's just incentivizing brewers and distillers to produce and manufacture within Australia. The next one is digital games developers are going to receive a refundable tax offset of up to 30%. So again, that's trying to keep jobs within Australia and increase our digital capacity within Australia. The next one is called the part of the Modern Manufacturing Initiative. And so there's $1.5 billion is being put towards grants and mapping and the priority maps associated with 6 key industries. So the industries are space, medical products, resources, technology, food and beverage, recycling, clean energy, and defence. So there's a bunch of grants available for each of those, under each of those sectors. So if that's something that's relevant to you, I'd highly recommend looking at those. The next one is aged care and NDIS initiatives. So there's a lot of funding and support to help aged Australians stay in their own homes rather than overload the aged care system. There's also a bunch of money being spent in aged care facilities as well, and just improved access to healthcare. 2.3 billion has been put towards the prevention and treatment services associated with mental health, which is something that's a key focus at the moment, which is great. There's a lot of stuff about women's safety and leadership within the budget. So there's 1.1 billion being put towards supporting women and children leaving a violent relationship, and just putting that towards emergency accommodation and support and services to support them, and also various processes within the legal system that will also help those people. $5.3 million is being put towards primary prevention programs and research into sexual harassment, and 26.2 million for improving the safety of online spaces for women and children. So a lot of that is around education and cybersecurity. The next dot point there is promoting women's leadership. So there's an expansion of the Women's Leadership and Development Program, and also some funding to help beef up the women in STEM, which is an industry where there's not much women participation. So there's a focus on getting that participation up. The next one, there's also some funds available for women's health, including various programs, maternal, sexual and reproductive health, which is good to see. A lot of support there, you know, for some specific conditions. Environment, so there's lots of programs for the emission reductions. They're still on track to meet various targets that that the government has been putting out there, and just improving recycling and waste management as well, which also comes back into that modern manufacturing initiative space, where there's you know, a focus on clean. One of the industries is recycling and clean energy. And then the last dot point I have there is just specifically for not-for-profits, which we do have quite a few clients that are not-for-profit. So just be mindful that, so in the past, we've been able to be exempt for income tax purpose on a self-assessment basis. However, starting July 2023, it will still be self-assessment, but you will have to submit an online form every year to maintain that exempt for income tax status. So I think that's covered off most of the key points of the budget. So there's some contact information on how to get in touch with us if you have any specific questions relating to your circumstances. Feel free to contact us, email, check out the website, or any of those social areas there. And I hope you've enjoyed this overview. I hope it wasn't too long for you and easier to digest than reading a bunch of information. Thank you again for joining us, and we'll hope to see you soon.